Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. Today's episode is going to be another great one. Two of the most talked about themes in the wealth management space has been the growth of active ETFs and artificial intelligence. Well, today I have on the perfect guest to talk about the intersection of these two topics. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am honored and excited to welcome Adam Patti. Adam is the CEO of VistaShares. Adam, thank you so much for coming on the show. Like I said, it's an honor to have you on. Now, can you please tell us a little bit more about yourself and VistaShares?
Sure. Well, thank you very much for having me. It's a pleasure. So I've been in the ETF market for a long time, probably dating back to 2001, when I ran a division at Time Inc. called Fortune Indexes, where we created an ETF based on the Fortune 500 index. We worked with State Street Global Advisors, the Triple F, and we launched that way back in 2000, 2001.
Wow.
Fast forward from there, I started a company called Index IQ in 2006, and we were focused on liquid alternatives, which was kind of a new term back then. And our flagship products were revolving around the concept of hedge fund replication, and built that company up, sold it to New York Life in 2015, spent 3 years at New York Life, working with the team there to roll out ETFs globally across their platform. And then I left there and was looking for a way back in, and here we are. So
Fantastic. Fantastic. So great. You got some great experience with ETFs. Can with VistaShares, it's also a relatively new firm, correct? And a couple of great products. Can you kind of tell us about your decision to start VistaShares and where that decision came from?
Sure. So, I've been looking, the ETF market it's a great industry, great people, smart people, just a lot of innovation. And frankly, it's certainly a lot more mature than it was, 15, 20 years ago, without a doubt. But there's still a ton of innovation and a lot of room, a lot of white space in the industry to grow meaningful business by, if you're creating, high quality tools for investors, which has always been my premise. So, after looking at a lot of different opportunities, I had the pleasure of meeting a gentleman named John McNeil. John runs a company called DVX Ventures. He was the former president of Tesla and the COO at Lyft. He's on the board of General Motors. He's a very, very intelligent man, been around the block in the tech space for many, many years, at the top of, the game. And his firm DVX Ventures, it's an interesting company. They have a lot of smart people there who kind of scour the world looking for industries and opportunities that they find where they might be able to add value or disrupt the current business model. And he had some ideas. We got together and we founded VistaShares. So it's been almost a year now that I started with them, and we launched our first product in December, and we have a whole host of new products that we're going to be coming out with. Hopefully, innovative, high quality products that advisors, find important for their portfolios.
Fantastic. Yeah. Congratulations. Looking forward to those new products. And we'll talk about that current product you have out there that you just released in December shortly. But you talked about innovation in the ETF space all the way from when you started that, your first ETF to now. And one of those innovations is active ETFs. Can you give us your thoughts on active ETFs?
Sure. Look, it's a rapidly growing area for sure. I was looking at some numbers this morning. I think it was around 1.1 trillion in inflows in the ETF market last year. About 250 or 260 billion of that is in the active space. So rapidly growing, and certainly from a market share perspective, rapidly increasing market share for active over passive. Look, there's a lot of benefits to active. There's a lot of benefits to passive. I'm not picking sides. for sure, because I think both have their place in portfolios. But what's interesting from a growth perspective of the industry, if you kind of extrapolate it out, um, active is approximately 6 to 8% of total assets in the ETF market today, 6 to 8, somewhere in that range. Um, if you look at the mutual fund market, and I was looking at some numbers this morning trying to really tease out the exact numbers, but call it over 50% of mutual fund assets are still in active strategies. So if you just look at that, and if you believe that the ETF market is growing up, similar to how the mutual fund market has currently matured over many, many years, you see there's a lot of growth opportunity in active. And investors are looking for to tap into the intellect of some smart people out there to find the right security selection, and portfolio construction techniques to hopefully give them better outcomes for their investors. So I think that's where active is really coming in. Certainly the passive space is incredible for core allocations, very low cost beta. So I think you need to have both in your portfolio.
you know, Adam, I can't agree with you more there. I personally, I tend to side with the active management, but when you're creating an investment portfolio, I don't think you should be, hardcore active or hardcore passive. I think they can work together in different asset classes. It's clear. I've done a lot of research within Zephyr that shows there's different asset classes where it's hard to find alpha, right? Especially now, it's really hard to find alpha in the large growth space. Whereas in large value, you can find alpha. So you got to look at the different asset classes and where you can find alpha, where the returns might offset the higher expenses and so on. So I agree completely with you that they work well together,
I
active and
agree.
passive.
And I think a part of it is also how dynamic is the sector that you're looking at. So, certainly in the large cap space, generally, broadly speaking, it's tougher to find that alpha
Yep.
because there's just so many eyes on those securities. But when you're looking at a sector like AI, which is rapidly growing, I'm just using that as an example, but any type of earlier stage sector, you need to be a little bit more nimble to find those opportunities and control for risks that pop up from time to time, like we saw this week, even in some of the news in the AI space. So, I think that, to your point, active and passive work well together, and I think you need to have a good mix of both.
Yep. So what's your approach on active ETFs? It's relatively new, but it like you said, it's growing. So what's your approach?
So yeah, so our first product AIS it's an active ETF, but we're a little bit of a hybrid because I still have my index bona fides from many years of working in the index space. So we're active to a rules-based process. So we think having the discipline of a rules-based process to form the core of the portfolio is valuable for investors in terms of transparency, and consistency in what you're looking for in your portfolio. So and then having that active overlay, overseeing that rules-based process to find those risks and those opportunities to move in and out and be a little more nimble, particularly given how dynamic some of these more technology-oriented spaces are. So and that's our approach. So it's active to a rules-based process.
Okay, fantastic. So you talked about, we often talk about investment cycles, and you mentioned AI, which has gone crazy over the past few years, especially recently. What are some super cycles that you're currently watching? Are there a couple? Is it basically AI? What's on the top of your mind?
So, we believe there's four main super cycles that are converging right now, which has really never happened in the history of investing or the economy globally. The last major super cycle was the internet, right? So that was obviously a sea change in the way that business was conducted, in the way people lived their lives and communicated. So the internet was a massive super cycle for sure, but that was just one super cycle. Uh, what our research and kind of knowledge base indicates is that we're looking at four now. AI is certainly one of them. Electrification, power generation is a second, and that would include everything from EVs, autonomous vehicles, straight through to how we power these AI data centers, and the various ways to generate that power, whether it's nuclear or wind or solar. And then, of course, robotics, which ties into both of those sectors, and biotech. which again ties a lot into AI as well. So in a way, they're all intermingled, but they're four distinct super cycles that we believe over the next 20 years are going to be the most disruptive trends in the marketplace.
Interesting. We talk a lot about energy, especially with the data centers. Like, how are we going to produce enough energy to, for this technology? And really, like you said, a lot of these four super cycles that you mentioned, the backbone is technology. So it's just so important right now, technology, regardless of what space you're in. Um,
Right.
so you mentioned AI. This week has been a big week. There's a release of DeepSeek's R1 model, which really rattled markets, whether you think it was overdone or not. Nvidia took a huge hit following the news. So what's your take on DeepSeek? Do we make too much of it, or is it really rattling the market, the AI market? And where do you stand?
I mean, look, we don't have all the information yet, and I think
Yeah.
every day we're getting more information put into the marketplace from various people a lot smarter than me on the space. But what I think the main premise that I would stick to is that innovation and competition is good in an early stage industry. I think we're in the first inning of AI. And regardless of who the winners are on the front end, so the consumer focused applications, the open AIs, the DeepSeeks, whoever is going to win that space, it's really almost inconsequential to our investment strategy, which you need the infrastructure. So regardless of who wins that space, you need the data centers, you need the compute power to get to those rapid, because these front end consumer applications are rapidly advancing. They're soaking up more and more compute power every day. So the data centers, the more powerful semiconductors are required to, continue the evolution of the industry. And in terms of DeepSeek, now I'm hearing things that DeepSeek, these $5.6 million that they were touting as is really about the training budget. So, if you look at AI, there's various stages of evolution or innovation in these models. So, training is certainly the first, inference is the second, right? So most of our US based models are on the inference stage. And just to clarify what that means, the training portion of this is where the programmers are introducing data sets to train the AI model on how to react and how to find patterns in that curated data set. The inference portion is where you're introducing new data sets, not the curated data sets that were provided during training, but new data sets, and having the model learn to identify patterns based on what it learned during training. And that inference portion of the evolution of the model is where all the power is required. You need to have more and more power to have these models learn more and more and be able to absorb more additional data sets over time so they can then make predictions based on what their pattern recognition tells them. So that's kind of a little bit of I think a wrinkle that wasn't necessarily brought to bear on Monday.
Yeah, you brought up a good point, and it obviously made headlines, and rightfully so when it came out. Nvidia took the heat, the whole market did. But though, then when you really sit back and think about it, and this is, I think, a lot with investing, we look at those headlines and we make those initial thoughts, but you got to step back and really think about it. This came from China, right? And we all know China's not going to be exactly open and transparent of what's going on, right? So I think you have to take it in exactly what you said, that initial, costs was with training. So what other costs are there that they aren't exactly telling us about, being um, up and center with us? So I'm glad you brought that up.
Yeah, I mean it's a geopolitical chess game, I think, and to some extent. This is a very important national security related industry, and everybody wants to own it. So Trump comes out with his $500 billion plan last week. 3 days later, China comes out with, well, what are you guys doing with 500 billion? We did it for 5.6 million. So, and I'm being a little glib around that. There's obviously more complexity, but yeah. So there's a bunch of posturing, I think, in there as well. We'll see what's really true when it all comes, it gets analyzed. But look, you've already heard, the Microsofts of the world reiterating their intent to make the investments. They announced 80 billion a few weeks ago. So the investments have to be made, and they're going to be made into the infrastructure.
Yeah. The timing of DeepSeek's release, it wasn't coincidental with President Trump's announcement. I
Yeah.
don't think it
No,
was. It was planned.
no.
So, what is your approach, and what is VistaShares' approach to AI?
So what we've done is, the problem with many ETFs, in the thematic space is when you really kind of look under the hood of what you're getting, you're not necessarily getting what you think. Um, so if you look at some of the bigger AI funds that are out there and been out there for a few years, and you look at their top 10 holdings, what do you have in there? You've got Apple, you've got Amazon, you've got Meta, you've got Nvidia, of course. Um, You've got Alibaba and Netflix and all these consumer-facing companies. Now, of course, we know that many of these companies are making massive investments into the AI space, but they're not AI plays. A very, very small portion of their revenue is coming from AI, and it's going to be like that for many, many years. I mean, they're making the investments so they can leverage that AI technology to enhance their value proposition to consumers down the road. Um, so what we do is, and this is was a revelation by John, my partner at John McNeil over at DVX, and really why he wanted to get into this space in the first place. He was looking for exposure into AI, and
Okay.
realized after looking at the ETFs out there that in fact these were not AI products. The as I mentioned, the top 10 holdings are the same big mega cap, mega brand names that everyone already owns in other funds or in their single stock portfolios. So the question then is, how do you get that pure exposure? So his insight was, well, let's look at the bill of materials. What companies are building the infrastructure, and in the case of AI, it's data centers and semiconductors. So what are the components that go into that? So
Okay.
let's dig in, let's apply a percent to total. So if a data center costs, I'm just making up numbers, $10 million,
Mhm.
how much of that is going into cooling systems, racking, fiber optic cable? On the semiconductor side, how much of that is going into VRAM and GPUs and all the other things that go into building these? Let's identify these companies, let's dig into the companies, see how much of their revenue is actually coming from AI projects, and let's build that into a rules-based process to form a portfolio. And so that's kind of the core of our portfolios, is bill of materials process to find the hidden gems around the world that frankly most investors don't own in their portfolios, have never heard of. I mean, some of the big names are in there, Taiwan Semiconductor and Micron and some other ones like that. But you look at our portfolio of 84 companies, and many of these are companies no one's ever heard of because they're under the radar. So that's the core of our portfolio. And I think one of the bigger innovations beyond the methodology I just described at high level is this investment committee. So we, in terms of our active overlay. So, you know, many active managers are, very smart people, analysts, and they're looking at the numbers. We took a very different approach. So we have four people on our investment committee. There's the practitioners and there's a portfolio construction people. So our practitioners are John, who, as I mentioned, is an expert in the space, around the world. A gentleman named Sunny Madra, who is a luminary in the AI space. He's the president of a company called Grok. He's been in the space for many years. They know these companies. They see the projects that are coming down the pike, who's winning projects, who's losing projects. So from finding opportunities, it's really about, identifying those companies that are winning or losing and moving faster than maybe the market can. And on the portfolio construction side, we have myself, and then we have Professor Robert Whitelaw, who is the dean of NYU Stern School of Business undergraduate school. He was the chairman of the finance department at the business school, a leading intellect in portfolio construction. So once they find those risks or opportunities, then Professor Whitelaw and I will get together and say, well, how do we execute this and to improve the portfolio?
Awesome. So what you're telling me, Adam, is there is a lot of brain power behind VistaShares and your strategies, is what you're saying.
You said it better. I'm a humble guy.
Yeah.
Uh,
Oh, fantastic.
what we're doing. But yes, yeah, we have a lot of expertise, and it's a different approach. I think
Yeah.
when you're a practitioner, you really know what's going on. I mean, Sonny's involved with data center projects all over the world. That's what they do. So he knows that Vertiv is buying, it just won X number of projects, or he knows in all publicly available data, obviously,
Mhm.
but they know what's going on, I think, before many people would.
Yeah.
And frankly, finding those opportunities, I think, is critical. But more importantly, is finding the risks. If
Mhm.
there are companies that are, hot in the space, that are becoming less hot because their technology is no good anymore, or they're losing projects, we want to know about that fast so we can
Mhm.
execute.
Yeah, Adam, I want to go back to what you said at the initial part of this, that question or answer was know what you're investing in. It's like, it seems like I bring this up almost every conversation I have. And it's so important when, whether it's a mutual fund, a separately managed account, ETF, know what you're investing in. Because one of the big questions I was going to have for you is, all right, another ETFs out there is Spider, S&P 500. It is so highly concentrated. It's like over 30% now in mega tech stocks. And like you said, a lot of those mega tech stocks are rolling out AI. They're investing in AI. If I'm a financial advisor and I'm looking to include these ETFs that have AI in it, how do I know there's not a lot of overlap between these ETFs, AI ETFs or mutual funds, and uh, S&P 500, which maybe might be your core holding, the Spider might be your core holding? How do I know that my AI investment sleeve doesn't have a bunch of overlap with all this other technologies that's driving the S&P 500?
Yeah, you nailed it. That's the major risk. Over concentration risk is something that many advisors, I mean, a lot of advisors do look at that, but many advisors may miss it because they're busy doing other things.
Yeah.
You have to run those overlap analyses. You have to, because if like you own the S&P, which may have a lot of these companies in them, then you're buying, have single stock portfolios where you own Meta and Nvidia for your clients, and then you're buying an AI ETF that has 30-40% of their exposure in those same companies. You're getting no diversification. You're not getting exposure to what you think you are. And frankly, when those companies go down, you're going to get a lot more drawdown than you might have
Yeah.
expected based on that, which is scary.
Mhm. And then 401ks, your basic 401ks probably got a lot of exposure to mega tech, those big names. So what should a financial advisor consider when incorporating an active ETF that invests in a niche space such as AI, but isn't sure or doesn't want to get that overexposure? What kind of tips can you provide those financial advisors?
Well, look, I mean, you can, if you don't want to run a detailed overlap analysis through your risk management system, the easiest thing to do is, of course, look at your top 10 holdings. I mean, right there, I mean, if you recognize all the names and you own them in, X, Y, or Z other funds, I mean, you might want to steer away.
Yeah.
You should be looking for funds that, provide exposure that you don't already have, complementary exposure, like, again, called the hidden gems. To give you that exposure that you just can't get elsewhere. That's important. And I think having and this is why we like the rules-based process for our core of our portfolio. I think having a repeatable, transparent process that you kind of know what you're getting from a process perspective, I think is important, instead of just having a bunch of stock pickers throwing names around. And being, again, a little flip on that as well. Clearly, the best stock pickers they have their own process. Difference with our process, it's all on paper.
Mhm.
Here's our process. This is exactly why we file. Why is this company in your portfolio? Well, X, Y, and Z. Their revenue is here. They're in this portion of the supply chain. They're a major player. We can defend every single company and why it's in there quantitatively, which I think is important.
Fantastic. So would you, in a product like VistaShares, where it's focused on AI, would you just do maybe like a satellite approach to investment or portfolio construction where maybe you take 10%, 5%? I know obviously everyone's going to answer, well, it depends on the client and the investor risk tolerance, but is there maybe like a sweet spot there in your research?
Yeah, I mean, again, I think you nailed it. It is dependent on your client's risk tolerances for sure. It is it's a growth portfolio. AIS is a growth portfolio, so it would be a satellite to your core portfolio of equities. And typically, depending on what else you have in there, if it's your only satellite position, you can have a 5 to 10%
Okay.
allocation to it for sure. But most investors or most advisors have several different themes they're interested in, or they have a single stock portfolio that's providing some of that growth tilt. So, maybe it's 3 to 5%, depending. So, and we're always happy to run those analyses as well to help kind of optimize based on risk tolerance.
Fantastic. Adam, great information. Where can our audience get more information about VistaShares and your AI ETF?
Sure. Well, it's VistaShares.com is our website. We're on LinkedIn and X and all those places as well. So follow us. One thing that I would note is that we are, we're pushing education. We think that, education is key. So we are spending quite a bit of money on developing in-house content, leveraging the expertise of our investment committee and other experts that we know in our universe, our circle of relationships. So, we do a newsletter every other week. We're putting another one out, I think, at the end of this week or early next, focused on AI data centers. And that's it's a good resource. Whether you use our products or not, hopefully you'll use the education because hopefully people will find it insightful.
Yeah, fantastic, Adam. I've gone to your website, VistaShares, quite often, and it's a great website, very interactive, and that content education guys are doing a great job. I'm a big believer in education, especially in this space. You educated me a lot on just the AI portion of it. A lot of people don't have time to dig deep in the AI, so leverage your thought leadership and your folks and what you guys are doing. It's great. Adam, thank you so much for coming on the show. It was an honor, a great conversation. I learned a lot. I'm sure our audience will too. And remember to get more information about VistaShares, it's VistaShares.com. Um, Adam, thank you. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel. Lastly, give us a follow on the Zephyr LinkedIn page to learn more about Zephyr and our research and content, as well as the Zephyr YouTube page. Thank you very much and have a great rest of your week.
Thank you very much for having me.
Mhm.